benefits us to a mild degree. It's not a big element of Berkshire. I mean, it's peanuts in terms of Berkshire's overall value, but it is a congressionally ordained tax benefit. I wouldn't call it exactly a shelter. It's a tax benefit that Congress has decided they're willing to offer businesses, and because they think it's the best way to generate low-income housing. So we participate in something, but it's not a big factor in what we do. And but there's nothing wrong with that. And then if you get into tax evasion, I mean, that's a whole different game. At that point, they ought to go to jail. But certain businesses, some insurance companies are reincorporated in Bermuda, and you can save a lot of taxes. You have to meet certain other tests which we wouldn't want to meet. But if we were willing to meet those other tests, there's nothing illegal or immoral about us moving to Bermuda. We're not going to do it. And but if the restrictions weren't there, I mean, the tax code is the rule book, and you follow the rule book. I think some of the things people do in terms of bending that rule book get very close to fraud, and sometimes cross the line into fraud. And when they do, I think they ought to be prosecuted. But that's another game. And incidentally, there has been more pushing on that, I would say, in the last 5 years, and certainly was my experience earlier. And there are more. I think now it's diminished in the last year or two, but a couple years ago there was some very aggressive marketing by some of the auditing firms, and of these, even with percentage shares of the gain to be paid to the auditors. And I think that those things got fairly dubious, and particularly when they shopped for legal opinions, so that if you got caught doing these things, you can say, well, I was relying on this legal opinion, and therefore I shouldn't go to jail, but just pay the back taxes. So I don't know of anything we're associated with that has done that, but obviously if they push too far, we don't want to be there.
Thank you.
Yep.
I was curious, with the large number of people you now have with tremendous amounts of wealth, what do you think of the current state of philanthropy? Well,
I'll be out this week. Actually, I'm going to a Coca-Cola meeting, and I'm flying out to Seattle and talking to the United Way group out there. Seattle United Way raises more per capita, I believe, than any United Way in the country. And Bill Gates will be there. We're talking jointly. His mother was very active in United Way. But Bill is going to give away over $1 billion a year. And a lot more later on, but right now $1 billion. And it's very interesting. I mean, he is very rational about it, and he's very informed. In fact, he got somebody, I think his primary advisor in the medical field is a fellow who was with the CDC in Atlanta. And Bill reads 15 books a month on this. I mean, he can just absorb it. I wouldn't be able to get it that fast. But he just says with $1 billion, he wants to save as many lives per year as he can. So that's his objective. It's just as much a metric of his foundation as some other metric, return on capital, might be for a business. And he says, I'm going to spend $1 billion a year. How many lives can be saved for that? So he's gotten very heavily into vaccines and AIDS in Africa, a number of things. It's very rational. I personally think all of my 99-point-something% of my net worth will go to a foundation after the latter of my wife and I die. I mean, it's all going to go to a foundation. As far as I'm concerned, I got it from society. It's going to go to society. I've written a letter to my trustees, and I've got very few trustees. If you got a whole bunch of trustees, in my view, they just homogenize themselves down to sort of a lowest common denominator, because you get 30 people in a room, and prestigious people, but they'll all have their particular alma mater, and they'll all have their particular hospital, and it'll become a big trade-off game. It'll be a little like Congress. So I have very few people, and I don't give them anything specific, because I tell them their judgment above ground will be better than my instructions from 6 feet underground. So I don't like to think that, but it's true. So I tell them, look, the society are the ones that don't have a natural funding constituency or are just damned intractable and very difficult to solve. So I tell them I am not going to haunt them at all if they spend big money on some terribly important problem and they fail, because they're taking on tough problems. When I buy businesses, I'm buying easy businesses. But the reason the big problems of society are big problems is that they're damn tough to solve. So they're swinging at bad pitches. I'm swinging at easy pitches in business, but they have to swing at bad pitches. But I tell them I want them to try and do it. And if they fail, it doesn't bother me at all. I tell them if they give $1 million here and $1 million there and $1 million there, they're not going to sleep because I'm going to be haunting them. I'm going to come back every night. I do not want the eyedropper approach used to philanthropy. But I want them to use their judgment to look at important problems that do not have a natural funding constituency. If the government's going to fund it, fine. They should be funding important problems, but we won't need to do it. The role of private philanthropy, in my opinion, is to fund things that don't have the natural constituency, and that's what Bill's doing. There aren't a bunch of people around that you can make an emotional appeal to make vaccines available to millions and millions of kids around the world. It doesn't tug at anybody's heartstrings. You can't name buildings after them. It just isn't the sort of thing that you can raise money for on an emotional basis. And there's nothing wrong with raising money on an emotional basis. But that is a problem that won't get solved by a funding constituent that's responding to that. But Bill is responding to what in his mind is the important thing, which is saving lives, and he doesn't care whether he gets his name on a building or whether anything happens or whether anybody knows about it. He gets publicity just because of the scale he's on, but he doesn't care about that. I can promise you that. So that's my philosophy, is that I got this money not because I'm a superior human being, not because I've done more for society than other people. I was wired the right way to be dropped into the United States at this particular time. It's a huge capitalistic society, and I'm wired, no credit to me, but I'm just born that way, so that I'm better at asset allocation than other people to some degree. Just like other people are better at all kinds of other things. And I was with 2 teachers out at Sun Valley that are doing more for society than I am, and this market system does nothing for them. Market system does all kinds of things for me. Gates says if I'd been born 5,000 years ago, I'd have been some animal's lunch, because I can't run very fast, and I can't climb trees. And I could tell that animal was chasing me, wait till we see how I could allocate assets, But it wouldn't have made any difference. So here I am, I'm born now, just very, very lucky. And the odds when I was born in 1930, the odds were 50 to 1 against me being born in the United States. That's a terrible set of odds to face. And yet I was dropped down here, And if I'd been dropped down in Peru or someplace or China, I wouldn't have had a chance. So society is what does it for you. And it should go back, in my view, it should go back to society. If you've been lucky enough to be dropped into a society where your particular wiring pays off big, that's just luck. And there's nothing wrong with being lucky. I don't feel guilty about it or anything else, but I also don't feel that, I feel I have a lot of fun doing what I do, but I feel the money should go back into society, and it should go back as intelligently as it can. And the best way to do it intelligently is to have high-grade and intelligent people administering it at the time. And you don't know the problems that are going to be out there 10 years from now or 20 years from now or 30 years from now, but I do know if I've got a small number of high-grade, smart people, and high-grade is more important. If you gave me 20 extra points of IQ, but cheated a little on the high grade, I wouldn't take it, because they got to be. There's so many chances to do things in a petty way, or to try to. People get subverted in their own minds to their own interests rather than the interests of the institution. So I really want super high-grade people doing it, and I've got them. And I think the money might do a lot of good, it may do no good, but it'll be operating in fields where if it does some good, that good probably wouldn't have been done otherwise. Yep.
I was just wondering, there's a lot of differences between the recent boom and bust in the stock market and one in the 1920s. But there's also a lot of similarities, and those similarities are allowing people to draw the conclusion that stock prices will be depressed for some time to come. Where do you disagree and agree with that conclusion?
Well, the whole century is quite interesting. If you take the 20th century, it was an unbelievable century for the United States. The GDP per capita And that's the way to think of it as per capita. Sometimes they talk about our GDP versus Europe's. But if their population's the same every year and ours goes up 1%, you've got to, in the end, you got to have a divisor as well as a numerator. And so GDP per capita in the 20th century in the United States went up 610%. Actually, qualitatively, it went up far more than that because you can't really measure certain things in medicine or whatever it may be and improvements. But just on a quantitative basis, it went up every single decade, including the decade of the 30s. So here you had 100 years when basically the U.S. citizenry was improving their lot decade by decade by decade. The 30s, it was up 13%. Best decade was World War II. The 40s, it's up 36%. The worst decade was the First World War. So you get sometimes you can get in trouble on analogies. But in any event, it was a huge period. Interestingly enough, there were 6 big periods in there for the stock market in both directions. There were 3 big bull markets. From 1900 to 1921, the Dow went from 66 to 71, less than a 10% move in 20 years, less than 0.5% a year. You got dividends too, but 0.5%. So it didn't move. From 21 to 29, as you point out, it went from 71 to a high of 381 in September of 1929. Went up 500%. Well, obviously, the well-being of the country didn't go up 500% during that period, and the well-being of the country went up a whole lot more than 10% during that first 21 years. So you got this very uneven development. Then from September of 1929 until the end of 1948, the Dow went from 381 to about 180. It was cut in half. And that was 18 long years. And yet the per capita GDP was moving right up during this whole period. So the economy was doing fine. From 48 to 65, the Dow went again from about 180 up to close to 1,000. Again, 5 for 1, which was far outstripping it. From 65 to 81, the Dow went down, literally. Well, again, per capita GDP. And then we've had this last period where it's gone up terrifically. If you take the whole 100 years, it went up 180 for 1. Every $1,000 became 180,000. But 43 and 3/4 years were those 3 big, huge bull markets, and 56 and 1/4 years were periods of stagnation, all in an economy that was doing fine, year after year after year. 56 and 1/4 years, net, the Dow was down a couple hundred points during that period, and the other 43 and 3/4 years made up the rest of this move from 66 to 11,000 some on the Dow. So you say to yourself, how could it be that you could have a country that was doing better and better and better and better? Citizens were living, every generation was living better than the one that preceded it. But you had these huge changes. Big gains a few times, long periods of stagnation. 20 years, I mean, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity. I mean, I lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but you want, it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21. And a Kansas City life insurance company happened to be a fairly prominent company in Omaha. And the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. I mean, he's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, a 2% investment on, and you can get 35% on your money. He said, stocks aren't any good, and I couldn't sell you. I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought sometimes I used to wonder if I was nuts, but those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move, and that you can't believe how discouraged people were during that period. But people were living better. So things can go on a long time that don't make sense, but they do come to an end. I mean, the internet thing. I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, and your neighbor's made money or something. You've got to be, you just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that, and people just go crazy. And of course, it's fun. I mean, it's like that sign they put in brokerage offices that says, "Avoid hangovers, stay drunk." I mean, it's just so much fun to keep playing. But you got to do sensible things to get good results. Yeah. Next. Well, we got 3 people standing there, so let's do the 3 that are standing there. Okay.